As you can gather, my name is Andrew Scorer. I work for IHS Maritime and Trade. Thank you very much for having me today. I'm going to keep it nice and brief. I've got 5 minutes. And you can take all the key takeaways for what I want to say is up there. And it's the tip of the iceberg, really. We've got a lot of data. If you want any of the sort of underlying information which I say, please come up to me and ask for some information. But the key question for me is actually, is the party over on the tanker market rates? The definitions I sort of think about it is it under capex or is it going to be, it is. If it's over capex, the earnings are over capex, then it's not. What's going to happen for the next 5 years is we actually think the earnings are going to be good. If we look at just the spot rate markets, freight rates for the next 5 years, for the very large crude carriers, we think it's going to be around $29,000 a day on the average. Peaks in this year and next year, and then dropping down. But if the typical capex at the moment for a VLCC is 23,000, we know that other owners are varying at different ages. On the Suezmax side, the actual earnings are about $24,500 per day for the average on the spot market for the next 5 years, with a typical capex in the low $20,000 per day. The Aframaxes, a little bit low on $23,000 a day earnings for the next 5 years. And the actual capex for the next 5 years is about $18,000 a day. So looking at it, the actual earnings is above capex, which is good. The next 2 years are going to be really, really good. Well, better and continue going on forward. But new buildings, should we do them? Is it going to be speculative? Is it strategic? Or do we actually do the second-hand new buildings? Depends on are you wanting earnings now or in 18 months' time? If it's now, please do second-hand buildings. And if you're going to do new building orders, we recommend doing this, we're saying do the strategic new buildings with long-term time charters. Let's keep the rates actually a lot higher than we've seen in previous cycles. We always talk about shipping cycles. I'm not going to put a supply-demand graph up there showing you where we are in the cycle. I'll leave that up to the panelists. But let's try and change it. Let's look at it and trying to keep the rates actually working together in the industry. There are going to be speculative new buildings, though. You can't help that. But how can we actually reduce that? Where should we actually put it in looking at the very large crude carriers or Suezmaxes or Aframax? If we're looking at IHS's fleet capacity forecast, for the VLCCs, we're saying that we think between now and the end of 2018, we think there's going to be a capacity of 203 ships ordered. We've got scheduled 127 at the moment. That's 63% of the actual potential order, what we can actually take. So that's a balance of 76. And that's actually, those 76 are taken into account of our earnings. I don't think we're actually going to have that many 76 new buildings, but if we do, that's quite a lot in the next few months. And that could look on the surface of really, really bad, but if we look at the fundamentals of all the supply-demand happening and oil demand with the low oil price, there is a potential to absorb all those new buildings. But please, I'm not saying go out and order 76 new buildings. The Suezmaxes, again, this is actually probably the tightest one. You've got 143 ships potentially which could be ordered, and scheduled is already 110. If you order a ship to be delivered in 2017, they're actually going to be over capacity straight away. That's the tightest market. So Suez is very, very tight, very competitive, and it would actually have a knock-on effect on those freight rates, which I said, the earnings on the spot market, which I said. The Aframax, we think there's the biggest demand on fleet capacity, and that's 260 ships to potentially could be ordered. We've got scheduled 162. If you look at the balance, that sounds a big figure of 98. 31 in 2017 and 67 in 2018. But 98 looks a big number, but there is potential that the tanker market can absorb those new buildings if they do come in. In conclusion, the party from IHS's point of view is not over, but it's not going to be a smooth ride. It's not going to be a smooth voyage, but that's exciting. That's what people want to be a part of this industry for. We want it to be volatile, but in the good earnings side of things. This year in 2016, on the near term, there's more positives than negatives. We've got Iran coming back online. We've got a good oil demand, increasing 1.2 this year and then going up to 1.5 million barrels per day in 2017. You're going to see strategic floating storage. We're seeing it on the smaller ones. We will have that most likely in the second half of this year when all the new buildings are actually arriving. So hopefully this will have a knock-on effect and absorb some of those new buildings coming in. The US exports, again, that's actually increasing ton miles. So there's a lot of positives. One of the only real big negatives which we potentially could see is the OPEC cutting production. We don't think that's going to happen until Iran actually does come online, so I think that's going to be affecting 2017. As I said, this is the tip of the iceberg of what a lot of data behind this. But I'm now going to hand over to the panel to see if actually they agree that the party's not over, or if it is, then what their views are why. Thank you very much indeed.
Thanks, Andrew. Appreciate it. So we're going to start off with the tanker panel. I'm Chris Wetherbee. I cover transportation and shipping at Citi, and I'm really pleased to be joined this afternoon by a really select group of players in the tanker space. Next to me, I have the CEO of Euronav, Paddy Rodgers. To Paddy's left, we have Ted Petrone from Navios, and to Ted's left, we have Tsakos from Tsakos Energy and Navigation. So really sort of an all-star panel here. And I like Andrew's setup here, talking about volatility, talking about the cycle, talking about rates. That's really where I want to kind of jump right in. And to be mindful of time, let's go ahead and do that. So Paddy, I'm going to start with you. I want to start sort of bigger picture and think about the tanker cycle in general. Where do you think we are now in the cycle, and how do you think about sort of the development of this cycle versus previous ones? What's the sustainability in your mind?
Well, I think there's a real danger in the way that people talk about shipping cycles, because sometimes it's up and sometimes it's down. They try to create this image that there's some sort of sine curve, and I think it's one of the most confused ideas that exist in shipping. There are three words that I like to use and like to be really specific about when we talk about the shipping market. One's cyclical, seasonal, and volatile. Those are the three things you have to understand about the tanker market. Volatile, because of the way we trade freight by selling it as a commodity, means that you can get within day huge movements. Sometimes when people are very excited and they've just started following shipping, they're all of a sudden predicting Armageddon because, did you see that a ship was fixed last night 20 points down? Well, this happens day in, day out. We've had movements far in excess of 30 or 40 world scale points when the market was averaging $100,000 a day. The market is volatile because of the way we trade our freight and the way we sell it as a commodity, and the way that any ships in position will determine whether the market moves up or down against the cargo that needs to be moved. So let's get that ring fence. That's volatility, and it affects us all the time. Seasonality, most of the consumers of crude oil, most of the consumers of products of crude oil live in the northern hemisphere. Generally speaking, it's colder in the winter. This year seems to have been an exception. We've had a remarkably warm winter. So generally we tend to see the hot quarters are Q4 and Q1. That's seasonality. And it's very, very important for making sure that you can absorb a lot of capacity during the winter in terms of really returning strong rates, even when the market's quite finely balanced. That's because the differential in demand from the summer to the winter can be over 2 million barrels a day. That's seasonality. Cyclicality has got nothing to do with the demand for crude oil. Over 25 years, only two years in 25 have not seen a growth in demand for crude year on year. Demand is steady. What's cyclical is cheap availability of capital to ship owners to go and cut their own throats, ordering ships that aren't needed or wanted. And why is it different this time? We just happen to be in the middle of one of the biggest periods of delevering that the world's ever seen. We had a 10 to 15-year credit bubble, and the end of that was signaled by the end of quantitative easing in Q4 of 14. We've seen commodities hit, we've seen home values hit, we've seen currencies hit, we've seen emerging market, capital markets hit. What does it mean? Investors are pulling cash back. Banks are getting hit really hard on loan portfolios. Just try and go and find the capital to order a new building. Go and see if you can find the capital to finance ones that you've already ordered. This is the new game changer. That's why I'm not prepared to make some prediction about where we are in the cycle. Are we at the end of the second inning? And this is just language you need to bin. Because we've got two different stories running here. We've got a fantastic story about demand for crude. Crude was being marginalized as an energy product by being forced up in price to over $100 a barrel. Now the price has been corrected down to where it needs to be to put crude oil right at the center of the energy mix. That means we're back in business. That means growth in demand on an exceptional basis, which we saw in 2015, which we see predicted for 2016 and beyond. So oil is back in business, we ship it, and we're part of the operating economy. The capital economy that's suffering, the one that many of you know about because you're capital managers, of course that's suffering. That's because people have egregiously spent money on things that weren't worth it. And now the chicken's coming home to roost. So this is going to help us. This is going to prolong the market that we're in. And right now, I refuse to call an end to the market.
Okay. Well, I was wondering if we were going to get any strong opinions about the market. I'm glad that we have at least one. So thank you, Paddy, for those comprehensive comments. I really appreciate it. You touched on a lot of the things that I want to talk about over the course of our time. So one of those being the order book, and in particular for this year. So I'm going to go a little bit sort of micro here. I know you gave us sort of the bigger picture view. Ted, I'd love if you could comment a little bit about sort of the order book specifically for 2016. So I talk to a lot of investors in this space. They're worried about the back half of the year. They see some of the big orders. Right. A lot of those are from one player in the market, but they're worried about them nonetheless. So kind of want to get your sense of how do you think about that order book? How do you think that kind of plays out? Can you work through it? Is there slippage? I mean, how do you think about sort of the dynamic maybe in the back half of this year?
You know, over the years, if you've looked at both dry and wet, there's been this ongoing non-deliveries on both sides. If you take a look specifically at the VLCCs, you'll see that non-deliveries have been running at over a third, maybe 36% in the last 3 years. It's not that there's half-built ships sitting around the world waiting to be delivered. There was a statistical error made back when oil didn't grow for those 2 years. Mm-hmm. And I have some sympathy for the research firms that sort of pushed this error forward all the way through. When you drill down, we saw 65 new buildings on paper at the beginning of this year. I'm already reading that it should be about 42, which is where a number of us had drilled down to at the beginning in terms of actual deliveries. And then obviously it gets a little bit less the following year, and then it sort of drops off the cliff. And as Paddy said, where do you see people coming in, buying this? I think the supply and demand fundamentals going forward on certainly the crude side and most specifically the Vs is if you've had a 20-year average of, say, 42,000, it looks like to us that you'll be somewhere above that for the next few years easily. I heard a number of 29, and Andrew also threw some kind of curve up with potential new orders. He's going to have to explain that to me later because that was sort of a curveball. I'd like to know where that's coming from. But the way we see it is if you have 5% fleet growth, net fleet growth, remember there's a lot of refineries still coming on in the Middle East, and that takes out the oil that the East consumption needs and the new West discoveries. The East is going to have to go farther to get their oil and come back. So I think if you have 1.2 million barrels a day growth this year, and we talked about 1.5 next year, I agree with that on Andrew's numbers. It just looks like you can, all the VLCCs and the Suez and efforts can be easily absorbed, not only by the volume itself, but by the ton miles going forward. Mm-hmm. I think the investors have to remember one thing. It's a simple sentence, but we're volume driven, not price. And as the prices went down in oil stocks, okay, I get we were energy related and we were related to China and everybody wanted to run out the door, but we're volume driven. And just look at the volume over the last 2 years going forward. We don't see that stopping. I'm sure we'll get into that. Mm-hmm. But the new building order for us is really a non sequitur. It really doesn't, it doesn't, maybe you'll be 5%, and we averaged 65,000 last year. Right now, we're sitting on 60 for the Vs for so far. So maybe we're at 60, you know, we're all gonna go cry all the way home.
Yeah, they could take that to the bank, I guess,
Yeah,
right?
cry to the bank is what I should have said.
That's very helpful. And so, Nikolas, wanted to touch on again, something that we've talked a little bit about so far. It's really sort of the capital markets. You've been public for a very long time. You've had, you know, robust experience in the capital markets. We're seeing a lack of capital. It's certainly something that investors talk to me about. It's certainly something that we're seeing when we talk to participants in the market. You have tanker as being one of really the only sort of end markets within shipping that are experiencing strength currently. We're seeing a pullback of sort of natural suppliers of capital to this market. You know, ultimately, should this be viewed as a very positive thing for tankers in the respect that we can keep that order book, these potential orders that Andrew talked about, down, and ultimately, I don't want to say extend the cycle because I don't want to offend Paddy here, but if you think about continuing a strong dynamic of rates going forward?
Yes, well, thank you. And I think we are talking about the party here, which we all like, and in order to keep the party going, I think it's very important to keep the alcohol prices low, which is, we have to keep the commodity that we consume and we move low. So I think that's a very, you know, nice association between, and I think if we can see the price of oil with all the things that you said, anywhere between up to, I would say, the mid-50s or $60 for the next couple of years, I think then we will be able to see the party going because it will maintain its mainstream demand as a commodity. I think there is certainly a distortion as far as tankers are concerned because we are associated, in a sense, rightly so, as oil, as an oil-related industry. So I think the majority of the investors, or many investors, are long in oil or were long in oil in 2015, and they sold whatever made a little profit, which were the tanker stocks. Otherwise, our underlying business has gone from strength to strength, and we knock on wood. And our share prices, I think most of us, have dropped almost 30 or 40%, just following the price, correlated with the price of oil, or should have been the opposite, because we are, I would say, in a sense, a hedge for the low oil price, because that's when our returns become higher. So I believe we have this misconception that we have all tried, but it's falling in deaf ears right now. But if I had to choose, I would rather keep my underlying business being strong, and I think the share prices will turn around themselves. Having this nervousness in the markets as a result of the oil prices, the unfortunate dry cargo market and container market, in a sense, it's the silver lining, if you want to call it, for the tankers that keeps people who order irresponsibly. It's like drive irresponsibly, they order irresponsibly new buildings. And I think speculative new buildings, the market has enough tonnage right now. I think the super eco theory has, is over from what we see, and we're still, as you see in the next panel, we're still suffering to absorb some of those old product orders into this market today. That's why the small ships are earning less than the big ships. So yes, that's a long answer, but a low appetite for investments in shipping is short-term good for us.
Well, I think Nick and I must have been talking to the same investors, because you say to them that it's a shipping company, and they say, what, like dry cargo? And you say, no, oil. And they say, oh, offshore. And you say, no, we carry it to China. They say, oh, no, emerging markets.
That's right.
I mean, all we can say to them is, just look at the dividend.
There you go. That's the cash flow will speak volumes, I guess. Paddy, maybe just on that as well, when you think about sort of the sources of capital into this market, so to fund potential new buildings, there's not a lot of it sort of washing around right now. How do you think about that in terms of, maybe impacts on cost of capital for existing companies, and if it's having more positive effects over the long run or potentially negative effects? And when I say negative effects, maybe you've seen the S&P market start to die down a little bit, so we're maybe in a little bit of a price discovery as far as what the actual market value of a ship is. I'm trying to get my arms around sort of what this means, this sort of pullback of capital as it applies to the tanker space, which is still very strong.
Well, I think that that's when you're taking a longer historical view, and I saw Martin Stopford was being given an award today, and he's always been, like to have long views, and I think it's worth having a long view and seeing that one of the shipping has been a victim of loose capital. We've suffered basically, I mean, if you look at the crisis of the VLCC crisis in the 70s, what created it was basically competitive underselling of shipyard capacity by the Europeans, the Brits, against the Japanese. And that's always been a risk, the national intervention of cheap money, and it basically makes it attractive to place a new building order. But, the reason why you shouldn't speculatively order is not because we don't want other people to make money. It's because those people do it, they go bankrupt, and the ship still gets built. So not only did they do something stupid, but we ended up paying the price for it. And what they're really doing when they go to a shipyard and sign a shipbuilding contract is to take a 2-year credit line, which is completely unfunded. Because the day that the ship gets delivered, they have to pay, and if they can't pay, then of course they're in trouble. And what they've really been hoping for is that cheap credit would enable them to resell without having invested much of their own equity and to make a fortune and walk away. These people are not in tanker shipping. And you mentioned the big owner that's taking a large number of deliveries this year. They're taking them because private equity ordered those ships. Those ships, if they weren't here and weren't needed, would basically guarantee all of us much stronger prices for our VLCCs and much higher rates for our earnings. It was an intervention that was based on very, very limited amounts of knowledge. Now, where's the money coming from going forward? I think the answer is this. We have to have sustained high rates, because that's the only way you're going to attract capital back into big ships. And that money will be needed in 4 or 5 years' time to rebuild the fleet and to give the world the safe and reliable shipping that it needs.
Makes sense. Ted, I want to talk a little bit about the supply of crude dynamics. So I think one of the things I get asked a lot of questions about is OPEC and production and sort of cuts, and have Iran saying that they might be willing to halt or freeze levels, but not until they get back to pre-sanction levels, which by my math is quite a bit higher than where they're probably running today. So, how do you think about sort of the production side of crude in 2016 and potentially even 2017? It would seem like it's a very bullish story.
I mean, it certainly is. For the OPEC to sit there and ask Iran to freeze at these current levels is unrealistic. They're not going to do it. So, let's just big picture it. If the U.S. is going to come off this year, a couple of 100,000 barrels a day, then you have Iran going up 300, 500,000 barrels. So you've got the same amount out there, but what's happening is you're actually taking something that's not transportable in the States, or maybe goes into the product, actually goes into crude and gets shipped. So again, I think it's a whole ton-mile play. I think listen, the IEA has always been soft or behind the curve. Last year they started at 0.9 million barrels, 900,000 barrels a day. They ended up at around 1.7. I mean, this year they're sitting at 1.2. Look at things going forward. I mean, look at China. Look what they've just done in the last 2 months. I mean, February was a record year of 8 million barrels a day imports. They're up 10% year on year. There's so much growth in China. Everybody worries about the growth, but because of the dry side, right? They've slipped down. But just think about, China's built all these refineries, and they still need to feed them. China has, just last year, look at the ratio here. China has 125 cars to 1,000 people. The States, it's 800 to 1,000. Okay, they won't get to that, but they'll get to 600, which is European. So you're going to need a massive amount of crude to fill these refineries that's going to feed the internal transportation going on. And if you just look on a per capita basis, the need that's out there with the supply, on a per capita basis, China's, the world is 1.6 times them. The U.S. is 7.5. I think we're a different story. Europe, I think, is 4.5. If they just get to world per capita consumption, all this, what we call extra oil that's out there on a daily basis, will be consumed over the next 6 years. Of course, the 10.5 million a day goes to 17 million barrels a day. And most of that has to be imported. And if you import 90% of that on VLCCs, over that same period of time, you need 285 Vs. And there's only 125 on order. And that's on paper. Let's remember, that's a high number.
That's right, that's on paper. So Nikolas, that gets me exactly into the next question I wanted to ask, and that is about China. So across sort of all of my coverage universe, there's a lot of questions about China, and Paddy mentioned investors get concerned about emerging market growth. Ted just sort of laid out a fairly optimistic, sort of viewpoint about how China can develop over time. I generally tend to agree with that from a crude consumption standpoint, but how do you think about sort of the potential risk, if there is some, to the demand side of the equation for crude? As Ted mentioned, the agencies have been sort of slow to kind of catch up to what we've seen has been better than expected growth. Do you see that this year? Is global trade and global economic growth decelerating in 2016 into 2017?
Well, I think the long to medium-term prospects from the developing countries are very positive. If you look still at if you compare the consumption statistics, even given for greener ways of energy as we go forward, I think consumption will have to double east of Suez in the next 20 years. So I think this is a long-term view. To be worried about China, I think it's over-exaggerated. China keeps on, if you have a giant that is growing by 5 or 6%, it's much better than it was growing 10%, which was a much smaller economy. So I think China is going to become one of the 2 or 3 largest economies in the world within this decade, and growth anywhere above 5% is still a very significant growth for a country like this. So I think we expected a soft landing. I think we are seeing a soft landing, in my opinion, in China, and the prospects going forward are good. And don't forget, you have other countries. I mean, you have India, which is even more larger country with a bigger middle class, with a eagerness to grow their consumption that is following through. So I think the growth is going to be in the East, and I think that's where we should concentrate.
No, apparently that wasn't working, so hopefully this is.
Maybe that one.
Does that one work? Oh, that's better.
A little better.
No, I just had a couple of points to add to that, because I think that you can keep looking at demand growth, which is one thing. And first of all, Nick's absolutely right. Smaller percentages off a bigger base. We're transporting volume, not percentages. So as long as the numbers are big, we get there. So China last month, over 8 million barrels of daily import, highest number ever. And people are saying to us, China's economy is failing. What we also see is the teapot refinery licensing. And why was that done? Basically, China's oil fields are beginning to go, they started flatlining last year and now they're going into decline. So this is consumption which was domestically supplied and which comes into shipping with nothing to do with growth. So you don't need any growth and you get a greater demand for shipping. The IEA is predicting for the next 2 years a 1.7 million barrel a day call on OPEC. Because whatever happens to shale, Chinese oil production, and Russian oil production, which is also under the hammer, is going to get shipped. Everything is gearing to shipping. So if you just took that 1.7 number and extrapolate it, that's close to a V cargo a day. OPEC call, next 2 years. Well, that's nearly 60 VLCCs a year. Now, these are all estimates, but all of a sudden you get this idea. In this industry, you must not look at the statistics unless you really think about what it means in terms of real shipping demand. Because what we're feeling is that shipping's very, very strong and demand is very, very strong. You can count ships on paper in a yard. You can speculate how many the yard may build, and you can give yourself a complete nightmare. But the one thing that's definitely happening is every day more and more oil is being consumed, and even more oil is being shipped than is being consumed. And right now, that's the driver behind the rates that we're enjoying.
And I think the overproduction has masked what Paddy's saying, this growth in consumption that's been going forward. And so everybody forgets that as we're growing here, it'll continue to going forward. I think the supply side, anybody really think that Russia and our good friends in Venezuela and all these others, when they have a budget of, $80 for government spending, they're going to stop pumping and they've never agreed on their OPEC. They've all been cheated. I mean, how is this going to stop going forward? The pressure's on them even more to continue to pump out of the ground and ship it. They need the dollars.
Makes sense. I want to ask about asset prices. I also want to make sure we're mindful of leaving a little bit of time for audience questions if there are any, but I want to ask about sort of resale market as it stands right now. Curious to get a sense. Let's start with you, Paddy. What do you think of VLCC, sort of 5-year and younger VLCC should trade for in today's market? What's an asset price that we should be thinking about?
It's a bit of a curious question. Look, if a year ago, people were hanging out there with a 5-year-old V saying they wanted 82, 83. What did we see the Tangier Rastanura go for?
Well below 80.
Well below 80, so I mean I think it was 75.
Yeah.
75 was the headline, but there may have been some commission in there. That's completely odd. So effectively, you've had a booming market, and you've seen the values go down. That seems a bit strange. So it's a mystery, and nobody should pretend that there's anything normal about this. And the way that we view it is that there are two stories there. One is the fact that you've got cheap oil putting oil back on and putting earnings back on track with oil at the center of the energy mix. On the other side, you've got a lack of availability of capital. A lot of those ship owners, unfortunately for them, are also in dry cargo. They're also in gas. They're also in containers. And what do you sell when you have to sell? You sell what somebody might just buy. The trouble is, nobody's got any cash. That's what's driving the market, not expectations of future earnings.
So that sort of goes back to my point about maybe it's the short-term pain from a lack of liquidity and maybe the long-term gain of keeping a lid on the order book over time. When you think about, which I spent a lot of time, probably too much time thinking about stock prices, when you think about that and the relationship to net asset value, an imperfect relationship to be clear, but when you think about that, we've seen significant depression relative to a lot of what we view as sort of appropriate net asset value in the space. How do you think about sort of the unwinding of maybe this difficult scenario we're in? Maybe we'll start with Nikolas down there to get you involved. How do you think about getting out of this sort of sub 1 times NAV? If we're all using the right numbers, maybe we're not, but how do we think about that? What's the catalyst to get these shares unlocked?
Well, as I said, I think right now the net asset values, as Paddy said before, are being influenced by a very negative sentiment that is carried for reasons that you mentioned, that has to do that a lot of owners, the lack of liquidity, and have mixed fleets. Mm-hmm. And you would not expect the prices of vessels today, after having a very good year, and 2016 looks to be a comfortable year, to be at about 25% lower than where they are today. And the same also, I think it's portrayed to the share prices. So actually, the share prices and the actual steel prices are having exactly the same trend, and the rates are going. So in case of such distortions, opportunities are there. I think tanker shipping stocks right now are cheap. They have good prospects going forward. Each of the companies that are there, the peer group, are the ones that have remained after the 2010-2013 crisis are strong companies with different philosophies, but all of them, very strong peer group in servicing the oil industry. So I think opportunities are there when such distortions exist.
Please. I think the answer to that actually is it starts with you, Christian. You have to start writing proper analysis that focuses on the earnings of our companies and not on our breakup value. Quite frankly, it's an insult to management, the way that we're constantly being pegged to the liquidation value of our companies. If you get our stock price priced off our earnings, which as we've explained today will be consistent and serious, You'll give us a stock price which will ensure that we can consolidate the market and we can drive the industry forward, not only for our own benefit, but also for the benefit of reliable and safe shipping. And we'll be able to guarantee you 60,000 a year every year, because that's what you need to attract capital and reward it properly to have a safe and good industry. But it starts and ends with the analysts. Drop price NAV from all of your reports, focus on the earnings, and make every public company pay dividends.
I mean, listen, the market's irrational, and Keynes said the market can stay irrational longer than people can stay solvent sometimes, and I think that's the issue for some people out there. So look, just to us, again, as Paddy said, there's no benefit here for management. I think those of us who have been in the game for 30 years, we're getting zero value.
That's fair. That's fair.
Don't tell my boss that.
That's not fair value.
We've always been a very strong proponent of using free cash and EBITDA as measures of the value of your companies, and so I think when it was not a popular topic, we were not fans of NAV, to be fair. But I think that's absolutely the right way to think about it. One last question that I have for the group before we want to make sure we have time for questions from the audience is storage. So it's a topic that I think gets too much play personally, but it's one that I get asked a lot about, so I'm going to ask you guys about it. So how do you think about storage? When do you hit the storage? Doesn't seem like we're there from an economic standpoint. Maybe 2 words from each. Ted, you're smiling once you
Well,
start.
how do we guess that was going to come up? Listen, it's quickly, in the States, it's 25 cents a ton, 25 cents a metric ton if you do it into the salt caverns. Above ground, it's probably 50 to 75 cents. And on a ship, it's $1. And so you need to be, the contango on the WTI or the Brent curve needs to be $6 up 6 months out just to break even. We haven't been there for a year and a half. So the reason we're at levels we are today on these ships has nothing to do with floating storage. And quite honestly, outside the States, it's hard to get where the actual numbers of where the storage is being built and how much. But it looks like to us and others that the extra capacity, if there is out there, that storage is being built outside of Chinese SPR this year. So it's not an issue. Sorry,
I think on a related issue with, I agree that right now storage is not a major fact, but I think, don't forget, we are seeing an industry today at 98% utilization. I mean, this is one of the highest levels of utilization. So the industry, through the participants, still has a leeway. There are things like, slow steaming, delays that can really throw the rates even higher. So the industry is well balanced. We have a well balanced supply and demand situation, and you can see how quickly rates can fluctuate and jump very high with a very small change in weather conditions, in delays, in ports, in slow steaming. So we are in a situation that I think storage is a factor, but it's not the greatest factor.
Well, I think, again, there's also the new intervention of shale. Someone was talking about OPEC cuts. I mean, forget it. What would be the point of OPEC cutting? They drive the price up, it brings on more shale. I mean, they're just subsidizing. They lose their own revenue, and they subsidize the oil price for the benefit of another. And one of the things that we've seen with shale is that a lot of the producers will sell forward. Now, you can open a contango up, but if you want to play it on a physical versus paper trade, it's got to stay open long enough for you to actually physically position a ship and load a cargo. Then you can forward sell the paper and match off the trade. But if the shale producer, every time he sees contango open up, sells into the 3 to 6 month space in order to get full value, then of course you keep pushing the curve back flat. And that's what we've seen the last 18 months.
I want to make sure, are there any questions from the audience? I think we have a mic or two that can get around if there are. Okay. Anybody? Great. Well, thank you very much for your time. Gentlemen, thanks for joining us. Appreciate it.
I think it's, we live in a world of technology, but the bankers and the brokers and the owners and the charterers need to get together on a physical space and talk about things and hear each other and see their body language and talk on panels and have experts like Martin Stofford tell us about long-term events. Again, day-to-day is very good, but you really don't get the essence of shipping unless you look at it on a long-term basis. And a conference like this brings out a lot of long-term players and a lot of long-term thinking from panelists that are being presented by Nick and his group. So I'm very happy to be here. The message I would say is come to the events.
it's always good, especially for the younger generation in shipping, it's always good to stay home, do your charts, be a chartist, read the numbers, but until you get out and meet the people, until you get out and get the feel of what's going on, and whether an owner is anxious or an owner is confident, that tells you a lot more sometimes, because charts can be very self-fulfilling prophecy, right? Everybody knows the left-hand side of the chart. I want to know what's going on the right-hand side, and you're not going to get that until you meet the people on the street.